Top of the morning to ya. Emergency fund and insurance. We've all got our emergency fund put together, whether you got a $1,000 emergency fund for a starter or a 3 to 6 month emergency fund otherwise. An emergency fund is kind of your self-insured platform. It's your self-insurance for employment. It's your self-insurance for breaking a phone. It's your self-insurance for a camera, or all the little things in life. Insurance, on the other hand, is a transfer of that risk for the big stuff, the stuff that we can't handle, the stuff that we don't have in our emergency fund, like the house, like my limbs, like somebody I run over with my car, like when I hit the Tesla with my car. That's what insurance is for the big health things, the big property things, the big injury, lawsuit, crazy things, and the life stuff. There's another small area of insurance that we like to cover as well. That's your identity theft insurance. And you want insurance in identity theft that's not just watching your identity, watching and monitoring your credit. You want one that's actually going to put things back together when the crap hits the fan. So identity theft is a big bad thing, and you can get it cheap. We get it for like $12 a month for our whole family, covering us and our kids. And what happens with identity theft insurance is, if you get the right kind, they take care of all the calls to the credit card companies. You're not liable for that stuff. You didn't authorize those transactions. And that's written in all the credit documents and all the banking stuff. It's not your fault. It's not yours. But when somebody steals your identity, it's your responsibility to clean it up. And that's where identity theft insurance comes in. So $12 a month, $144 a year, we get ours. You can find that out there on the internet. But make sure it includes credit cleanup, taking care, diagnosing, figuring out. You'll have to meet with them and invest some time, but they'll take care of the communications. They'll take care of the cleanup. They'll take care of recovering the losses and whatnot. There's 6 other insurances that you want to have on your radar. Some of them you need now, and one of them you need later, and possibly, unless you're over 60. The first one is pretty common sense. It's a law almost everywhere in any state, is auto insurance. You want to get enough auto insurance to pay for the auto. Not just your auto, but those other autos that you might hit. And some of those other autos are getting kind of expensive out there. I recommend getting a little bit higher coverage than the minimum standards. So I think we've got a 500 instead of 300. I think a lot of them start at 300,000. So you want to get a little higher to cover those big bad cars and the people involved in an accident. If you need to lower your payments on your insurance, you can raise your deductible, have a higher deductible. We have a $500 deductible, and that rolls in when our kids start driving. Hey kid, you need a $500 emergency fund. But I'm only 16. Exactly. You need a $500 emergency fund so that when you crash the car, it's okay. You have financial peace. And that's what all this is about. The second type of insurance for homeowners is pretty standard, pretty straightforward, and that's homeowners insurance. If you own a home with a mortgage, they're going to force you to get that, and it's probably already built in to cover the bank, because the bank wants you to have insurance on their house. They own the house, you're paying for it over time, and eventually you'll own it. But homeowners insurance is really key. And you want to make sure that it's a replacement cost if at all possible. A lot of times you can get an insurance policy and save some money, but then when you have that catastrophic loss and your whole house burns down, there's not enough there to cover the replacement of it. We're just coming off of a big repair on our living room, our kitchen and dining room area, and our entryway, our crafting room, and we made some upgrades during the insurance, but it really covered all the mess, got it all cleaned up. If you're not a homeowner, you want to look at getting renter's insurance. It's really, really cheap, and it covers your stuff. Dave Ramsey tells a story when he teaches this subject about one of his renters, and one of the properties he owned burned down, and the renter says, when can we expect replacement of our couch and our furniture and our items? And Dave's heart was ripped out inside, because that's not his responsibility. But he loves people just like you and I do, and he was tore up about it. But he's like, I'm sorry, the couch and table and furniture are your responsibility. That's in the lease agreement, that's yours. The property, the house, is my responsibility. And no, none of this is fun for any of us, but it just got a whole lot worse when that renter didn't have renter's insurance. If you don't have renter's insurance, you need to head out and get it right now. It's really cheap. I don't know, it's $35, $50, $100 a year, and it'll cover your junk inside. Because most of the time, nothing's going to happen and it's going to be okay. And that's what insurance is. It's kind of a club of, let's watch out for the other guy. So get that renter's insurance to cover your stuff. Once you're through all this, once you're at the end, I'll come back to that later. Next, health insurance. Health insurance is kind of a hot topic in the USA today, here and there and all over the place. But you want to get adequate health insurance. Companies are offering and providing less and less of it all the time, and you need that health insurance. We save a little bit on health insurance by being a member of Christian Healthcare Ministries. We have to abide by Christian principles. We have to get a note signed from the boss, from our pastor, to get into the program. But once we're in it, we're really giving and sharing with other Christian families to cover most all of our health costs. We pay for the first chunk, it's like a deductible, and if it's over $1,000, they step in, and it qualifies as health insurance. So I'll put a link down in the doobly-doo below this for health insurance. The next one is disability insurance. Everybody needs disability insurance. If you are working, if you are the provider in the home, in the family, you need disability insurance. And we're looking for long-term disability insurance. There's short and long. You want stuff that happens after 6 months. So you gotta, if you get hurt and you're out 3 months, that's covered by your emergency fund. That's self-insured. Why do we go with the long term? Because it reduces the premiums. So disability insurance steps in when you are disabled and you cannot function at your job. You want a good disability insurance that will replace that disability. That's called occupation. You want occupational or own occ disability insurance, so that you can't do the job that you are currently trained to do. And you can get that for 2 or 3 years, 3 to 5 years, to give you time to train and transition to a new career with your new abilities or inabilities. Or you can get it, what I got is to 65. So I get a portion of my income till 65 after I'm injured for 6 months and continue to have a disability for the rest of that. So that's above and beyond what the government supplies. So that'll provide 65% of my income, and we have a longer, it's called the elimination period, before it starts. It doesn't start for 6 months to bring down the cost of that insurance. We already talked about identity theft insurance. The next one is life insurance. If you, once again, if you are the provider, you are the caretaker, and that may be both of you. If you're a married family like ours, you want that death insurance, that if I die, a lump sum is given to my family to take care of paying for the house, paying for college, paying for all of our expenses. This is a permanent situation when you die, and a good place to start with that is you need 10 times your income. So 10 times your income is going to be a good starting point for getting the amount figured out for that life insurance. And then you want term life insurance for a specific period. After the kids are off and done with college, after the house is off and paid for, I don't need that life insurance anymore. My emergency funds and stuff can handle that, and my investments can handle that. So at that point, I become self-insured. Sometimes you can get the life insurance from your company for a smaller amount, not usually the 10 times your income amount, but you can upgrade that policy. The risk of doing that is if you switch companies and stuff, it gets to be messy. The younger you are when you start the life insurance, the lower your premiums are going to be and the costs are going to be. But life insurance gives me that peace of mind. If I drop dead sideways, my family has a lump sum of money to pay off the house, have invested to create an annual income to provide what the family needs going forward. Also, my wife is starting a business right now, but primarily is a home caretaker. She takes care of the kids. She takes care of me. Look how fat I am. She adds and provides a lot. And we've got younger kids in second and fourth grade. Oh, they just graduated, going into third and fifth grade. They're so excited. So the value and contribution she makes here to enable me to do my work and yet spend time with the family is invaluable too. So we have life insurance for her. It's about half the amount of mine to cover whether we need a nanny or a cook or a cleaner or things like that to carry on in recovery, in mourning, through that season and beyond, to maintain our lifestyle, to maintain our financial peace, our space peace. The last insurance that I'm going to talk about of the 7 that you need to have is your long-term care insurance. Once you're over 60, they say, I think it's 80% or more people end up needing long-term care. And that long-term care insurance is going to take care of and pay for that assisted living facilities, in-home care, nursing, and all those things that you need. Dave's done an assessment and the price breakdown, and at age 60 he recommends getting that because you can get the lower premium by starting early, and you just continue to pay that until you start using it. And if you don't start using it, yay! You don't feel bad. And you're helping contribute to other folks who do need long-term care and are in the 80% that actually end up needing it. But don't get that till you're 60. Get long-term care insurance to cover nursing homes, retirement homes, communities, to maintain your life. So those insurances: auto, home or renters, health, disability, long-term care, identity theft, and term life insurance. Get those 7 in place, and those go side by side with your emergency fund. Don't buy all these crap insurances out there. Don't buy all these gimmick insurances out there. Don't go and get a new phone because your 2 years is up. This phone's just barely 2 years old. I plan on having this phone for another 2 to 3 years, maybe 4 or 5. You don't need to do that. You don't need to buy credit insurance. You don't need to buy cancer insurance. You know what health insurance is? It's your health. Do you know if you have cancer, you're not healthy? That's covered. Don't buy death insurance, accidental death. That's your life insurance. You already have that. Don't buy burial insurance. Don't buy a burial plot. Don't buy mortgage life insurance. Don't buy any of these fancy insurances. They're just gimmicks. If you buy a plot of land from a burial place at a price, they get to invest that money for years and years and years till you die. Sure, you could die this year, but who's planning for that? Get these 7 insurances in place, stack them on top of your emergency funds, and this is going to increase your financial peace. You be blessed.